Hi there. Welcome to my YouTube channel. My name is Eric and I'm from 5minuteinvesting.com. So today I just want to talk about a book that I'm quite interested in, and I think it's a good book. It's actually called The Dip by Seth Godin. And it is actually a marketing book, and it talks about when to quit, which is quite interesting. And you know, I read a lot of self-help books. I read a lot of books about business, strategy, finance, stock market, and so on. So I think one of the things that are not commonly talked about, it's actually, what is the road to success? How do you become successful? There's a lot of mindsets out there. There's a lot of books about the principles you need to follow, like win-win, the 8th habit, to becoming a more successful person, so on and so forth. But what I think is not covered quite a bit is actually the journey and what you should expect. And the reason why it is not covered, it's really because it's difficult. It's unpredictable. It fluctuates a lot, and each journey is different. And if you go out and ask a lot of people, entrepreneurship, starting a business, investing, I actually think they're all related. You'll realize that they will say, well, each journey is different. But at the same time, there are similarities that you can learn from. So that's what this video is about. It's a pretty niche topic, and if you stumble upon this video, it's really because you're looking for the road to success, which is not covered in any books I read so far. So let's talk about the 4 models that I have here that I drew out for you. Now, a lot of people, when I talk to them, or when they schedule a strategy session to talk to me, they want instantaneous results, or they want to make money. They just want to bam and successful, and I understand where they're coming from. I understand that there's a current situation you're in pain of, and you want to get to your desired situation, whether that's making more money, getting $2 million or $1 million, or whatever your financial or emotional or spiritual goal is. And when they describe it that way, when they talk to me, a lot of people think they can just get there instantaneously. And here is it's a very small chart that I use to describe this model, and I call it magic. It's because they kind of skipped everything in between, and they just want to reach that destination. And they often get disappointed because that's really not how reality works. I want to be a doctor, and tomorrow I'll be a doctor. That's not really how it works. And there is work involved. You need to learn. You need to practice. You need to build your skill. So then, in order for you to get results, whether that is getting a higher return in the markets like 30%, or whether you want to be an influencer, or whether you want to be a successful entrepreneur, there's really that process. And that process really comes from knowledge, practice, then you see results. So it's not like you can reverse this process and start seeing results right away before knowledge and before practice. So that's what really the book The Dip is about. And Seth talks about how to be successful, and most people quit during the dip. Now, what does the dip mean? And of course, if you want to support the author, make sure you go buy his book. I think it's a good book, and if you read it as an entrepreneur, as a businessman, as an investor, that will help you out a lot, and it will help you be prepared of what you will encounter in the near future. So the dip is really when you start a project or a business or whatnot, you will encounter the initial down phase. Let's call it the down phase. And this is what Seth calls the dip. Basically, whether your business is incurring costs until it's profitable, or whether you're just learning and you're just trying a lot of things that are not working out. And this is the dip. And most people quit here at the bottom of the dip, or a lot of people quit just when they're about to break even, and then afterwards that becomes positive. So when you're looking at the dip, if you are never prepared to go through this journey, you're going to quit because you didn't realize how difficult it is. And I think that's really important, because when you're trying to start a business, a lot of people don't realize how difficult it is. And they just think it's going to be a walk in the park. But there's going to be challenge after challenge after challenge. And initially, when you're not self-sustaining yet, that is the most difficult, because as a company, you're going to incur the most losses up until this dip, this point. And emotionally, or when you're investing, you're going to incur most of the losses, and you're going to try a lot of things that don't work here until things starts to make sense to you. And so if you are about to embark on a new journey, maybe you're learning about investing, maybe you're going to start a business, you need to get through that dip. Now, how long is this dip, or how many years does it take to get through the dip? Now, for some companies like Facebook, you're going to realize the first 3, 5, however many years, they're actually not profitable, and the dip is quite long. For myself, it took me 8 years to master investing. So my dip was 8 years. And a lot of people didn't realize that if you need to learn investing from scratch, if you need to learn investing just by reading books, if you need to learn investing just by watching some free content on YouTube, it's going to take you a while. Because, just go search investing on YouTube and you're going to find a ton of videos. And a lot of people think, well, I can just rely on the free materials on the website and become a master. And the answer is yes, you can. And the question is, how much time do you need to go through all the materials? Because in reality, when you go out and you start doing your search, the search for the formula, because once you figure out the formula, you start going up. Once you figure out what the formula is, you're going to be in this phase. But before you figure out the formula, you need to go through basically all the misinformation, all the strategies that don't work. You need to test it yourself. You need to practice the techniques, and you're going to be running around in circles. Like, you're going to feel like you're running around in circles, especially when it comes to investing. There's over 100,000 books, or there's over 10,000 books based on my last memory on Amazon about investing. And if you just go through 1% of it, that's like 100 books. To figure out what strategy works for you, whether you want to be short-term, swing trade, long-term, and you need to go through that dip, and then you need to test it. If you don't have a good testing software, you're going to be testing with real money, and that is going to cost you quite a bit. And a lot of people think they're paying the market to learn about the market, which is extremely bad, because you're just making this dip go lower, and a lot of people get taken out. I have met people that have scheduled a call with me that have a negative 80% loss. During some of my earlier years when I'm learning investing, I have 100% loss. That is actually quite bad. And if I didn't control, if I didn't have risk management, I would lose a significant part of my savings. So this dip can be years. And for me to master investing, it took me 8 years. And for businesses like Tesla, Square, Facebook, Google, a lot of early years, they're actually incurring losses. So you need to have the ability to go through this dip and achieve scale. Now, maybe it's scale, maybe it's figuring out the formula, maybe it's perfecting that formula, so then it starts compounding. And that really brings me to the next model. But before I get there, I think one of the questions is, how do you shorten the dip? So one way to shorten the dip is actually to find a proven system that works and use it. So for example, I have mastered investing now, and right now I'm making around 40 to 50% each year as we speak. And I developed a coaching program that can teach people how to use long-term investing with stock options to make 30% a year in 4 weeks. And when you compare that to my own personal journey of spending 8 years trying to figure this out, getting a CPA degree, I can shorten this process for somebody with no financial background to 1 month. So if you have 1 month, just 12 hours, I can teach you the whole thing. And I can shorten your dip and get you from here to here in just 4 weeks. So you can see, if you have a proven system and you learn from someone like a mentor, this dip will be shortened and your loss will be minimized. And that is probably the most important parts of a mentor. And if you look at, for example, Elon Musk, initially he started PayPal, then he started Tesla, then he started SpaceX. You can think about it. If you think about the probability of an entrepreneur succeeding, it's like 100 to 1. So how come a man can have repeated success with entrepreneurship? And the answer is actually quite simple. It's because for the early years of Elon Musk, he actually figured out how to build a business. He went through the dip. And once he went through the dip, he realized how to build a business. So the next time, he just uses that formula he had to build PayPal, and he applied it to his next company, Tesla, applied to his next company, SpaceX. So you can see how success can be repeated once you figure out what the formula is. But initially, you need to go through that dip, unless you have a mentor, which shortens the dip. Okay, so the bad news is there is the dip. The good news is there is a way to shorten it. So let's talk about the second model, Warren Buffett. Now, Warren Buffett is most famous for compound interest. It's about having gains year after year, growing, at a percentage, maybe it's 10%, maybe it's 20%, maybe it's 30% year after year, and then in the end, you will make a huge gain. Now, this is quite important, and this is actually called the hockey stick. And a lot of startups use this model basically when you achieve market dominance, basically when the market grows as well. So why is this important? And what does it really mean? A lot of people think, well, compound interest is about reinvesting, is about putting in, the money you earn from your stock or your bond back into your portfolio and don't touch it, and so on. But what this really means is that initially when you start, you're not going to see any gains or very minimal gains. Imagine you invest $10,000 and you make 6%. That's $600 a year. It's not that much. But if you keep compounding it after 20, 30 years, suddenly it starts to snowball and it becomes really big. But at this point, you're not really doing a lot. You're putting most of your effort here. Remember the dip? You're putting most of your effort here and you're getting a payout at the end. And this is really the lag or the delay between your action and the results you get. Just like if you want to build a YouTube channel, initially you're going to have like 1 subscriber. Maybe your parents are following you, or maybe your best friend is following you. And over time, as you advertise your YouTube channel, then you get actually more and more people following you. And then in the end, you might be each week getting 10,000 subscribers joining your channel, but you're not actually doing anything more. And that's really the power of compound interest. And it's important to keep that in mind, because for a company, when they grow, when you're investing, there's compound interest too. Like, for example, my target is to make 30% a year, right? That's pretty straightforward. So initially, when I started with 3K, I make 30% a year, which is $900, which is not bad. But then because I know I can do this again, I leave the money in there, I save, I put more money in, and I just keep letting that money grow. And now I think last time I checked, I'm over 200K in terms of investing. So that is really the power of compound interest. And when you think about it, the money I'll make in the next 5 years will be a lot more than the money I make in the last 5 years. So that is really the difference. And it's important to build this and this together. So these two models are not separated. They're actually together. It's not separated models. It's actually a model that is together, because once you achieve and you've gone past the dip, what is the next thing that's going to happen? Compound interest. And a lot of people separate it, but in reality, it's all together. So when you combine these three models, you actually get a very complicated chart, and it makes every journey very unique. But if you break the journey down, then it's actually just these three elements. So if you understand these three elements, then you will be mentally, physically, and spiritually prepared for what's coming. All right, so the last model is called the market. Now, I just made that up because that's the best way I can use to describe it. But essentially, you can see that it is a wave. You know, there are unexpected things happening in life, and you're gonna get ups and downs. You know, sometimes you're gonna get ahead because it's just the way the market is. Sometimes you're gonna be behind, and I think that's pretty straightforward. But when you combine this with compound interest and combine with the dip, then suddenly you get a very complicated model where you have to go through the dip, start building your action on top of each other or your business, and then sometimes you get up and downs. And when it is down, you need to figure out how to get back up. And that is the market. And when you combine all three models together, then you have a very good understanding of how investing works. You have a very good understanding of how the market works, and you have a very good understanding of how to build a business, kickstart your career, or whatnot, because you're going to be going through the dip, you're going to be building on top of your previous success, and you're going to be taking advantage of every single down correction, and then you're buying again. So that's really my understanding of Road to Success. And once you understand it, it's a lot easier to go through because now you're mentally prepared. So my name is Eric, and thank you for watching this video. I teach people how to earn a higher return from the market, and my target is around 30% a year. So you can click on the link below, and there's actually a free webinar which explains what I do, and the webinar also teaches you about investing and how I invest in the markets. So make sure you click on that, and you can watch that free webinar. And I also offer free consultations as well. So after you watch the free webinar, you can schedule a time to have a chat with me, and I can answer some of your questions and see if you are a good fit for my coaching program. And my coaching program is about taking people through 4 weeks of investing training so that they become independent and they have more control over their financial destiny. And my investing strategy is called long-term investing using stock options. And it's a bit counterintuitive, and yeah, it's something you don't learn in school. So if you like this video, click like, share, and subscribe, and leave a comment below, and let me know if there's any other topics you want me to cover. So that's it for today. I'll see you next time.